Real estate investment practice problem using OneNote. Amortization schedule, where we will be changing the rate, holding everything else constant, looking at what the impact will be on the outcome, and amortization schedule. Get ready, because we're going to be raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab, down in the 4110 Amortization Schedule Rate Changes tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our practice problems will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're looking at our amortization schedule. This time, however, we're going to be holding all the other data components constant and focusing in on changing one, that being the rate. Looking at the impact of that change, primarily first thing people think about as with regards to the rate change would be the impact on the payment amount. But that's not the only thing we want to be taking a look at as well. We also want to be thinking about the impact on the interest over the life of the loan, possibly tax implications, possibly the loan balance. So we can think about what would happen if we were to sell the home at some future point in time. Now, as we go through these, we're going to be starting to change one component at a time. It's useful to keep in mind the components that can change. Although it doesn't look like there's many components involved, it can actually get quite confusing when you start to focus in on the components that can change. So in other words, we will typically, and the typical way to look at this would be to say we're going to focus in on the payment calculation, which has been done with a function in Excel, and then change the variables up top to see what the impact would be on the payment calculation, and then the impact on the amortization schedule, and then possibly the impact on, say, year-by-year numbers with regards to interest and loan balance and so on and so forth. So the components that could change for the loan amount would be the loan balance. Typically, we could change the loan balance, focus in on that, change the term. The term is usually more fixed, 15-year, 30-year, 30 years being a more standard, but the term could be different as well. And then we can change the rate. The rate is what we're going to focus on here. You can also flip the perspective and say, well, what if I have the payment being fixed to what I think I can budget my payment to be, and then determine, keeping everything else equal, the changing factor being either the rate, the period, or the loan balance. We'll do that in future presentations as well. So there's actually quite a lot of components, factors that are going in here. Also note that when you look at the loan amount, then you get it back into the home amount and think about, well, what would be the value of the home that you're purchasing, and whether or not you could put 20% down or possibly some other percent if that was applicable or able to do as well. That would, of course, change the loan amount. Also realize that when we change the years to 30 to something else, we take the years times 12, which would automatically change our months here. So here we're focusing in on the rate. We're going to say starting point, the rate's going to be 5%. That then calculates our payments at the $2,147.29. We can calculate the total payments and interest quite easily for the entire life of the loan by simply taking that 2147.29 about, because it's rounded, times 360. That then gives us about the total payments for 360, the life of the loan. If we subtract out the loan balance, $400,000, we get then to about the amount of interest for the entire loan period. But what we would like to see is a month-by-month breakout, possibly, and a year-by-year breakout. So the first thing we would focus in on is we'd say, okay, well, what if I change this rate? And let's think about what the impact would be on the payment amount. Now, if you were to do this one by one, you can change the rate right here, and it would change the payment amount right there. And you can do it one by one in a similar fashion as you can do with an online calculator. This is an example of an online calculator, and you can change the rate here from 3% to 4%, recalculate it, and it'll recalculate the payments. If I change it to 5%, recalculate the payments. That's the first thing that people think of generally. But you might also want to see it. It'd be nice to see it side by side. So what we would like to do is say, well, what if I have side by side a rate change, this one increasing by an increment of 0.25, 1% to 1.25 to 1.5, and so on. What then would be the payment change So I can see it right there and see how much basically 0.25 change would be, or the impact would be on the payment. So that's the first thing we can kind of do. We can change it here. So what we'll do is change it here, and then we'll actually make a little drop down that we can kind of verify in our actual data, pulling from our data set to there. So if we did that, all we would do is we'd say, okay, here's our list of rates, which we can just increase by a factor of 0.25. And then we're going to have our payment calculation, which would look something like this. The first one would be payment, the rate. The rate would be now this rate, the 1%, instead of this rate. We're gonna later on pull this information from our rate table here. So we got the 1%. That's not going to change. That is going to change. Therefore, no absolute reference, because when you copy this formula down, you would want that cell to move down. Then comma in our argument, the rate has to be divided by 12 as well, because this would be the yearly rate divided by 12. So we take that cell divided by 12, comma, number of periods. The number of periods is here. That's going to be constant, which would be 30 times 12, which we already calculated. So we're just pulling this cell, 360. That cell's in our data set. We do not want it to move down when we copy this formula down. Therefore, we make it an absolute reference, $ before the B and 6 in this case. You only need a mixed reference, $1, but an absolute one works. So we put that there, and then comma, the present value. The present value in these terms is the loan amount. So not the home value, but the loan amount, $400,000. That's coming from the data set. Therefore, that's being made absolute reference as well, so that it does not move down as we copy down $ before the B and the 4. And there we have it, and that gives us our result. Now, if we copy that down, very easy to do in Excel once it's set up. The second one, for example, would look like this. Would have the payment, the rate. The rate would be A16. Notice the cell here moved down. This now referring to the next cell, 1.25% divided by 12, comma, number of periods, absolute reference. Note the same cell due to the $, due to it being absolute. That's going to be the number of periods, which is going to be 360, comma, we have the present value, also absolute, also cell reference, and that's going to be the loan amount of the $400,000. So now we can see our payments changing step by step quite nicely, and that can be very useful for us for the first step, for just kind of our budgeting needs and how much the value of a change in an interest rate would be. The next thing we'll look at how to do, and you would do this in Excel. We do work this problem in Excel, but we go through a lot more Excel jargon and whatnot when we do so. So you can think about this and see if you want to practice constructing it or use the table, use this worksheet if you so choose. We're going to try to pick up this cell, and I'd like to have a drop down so that it will then be referencing this rate list. Reference this rate list, and then whatever the rate that we pick, in this case we have 5% there, we should be able to match up this table, which is the 2147 it's rounded to the 2147, giving us that kind of double verification that our information is correct. To do that, you would go to the data tab. So we got our cell on this cell right here. We want this little thing, which is a drop down. So we would go to the data tab up top. We'd go to the data tools. We click this little button right there, and that will allow us to say, do we want any value in here? That'll be the starting point. We're going to say, no, we want drop down here list. And then we can pick this whole column representing that list of percentages that we have. And that then gives us this nice drop down in that rate cell. So then you got this drop down, just a little fancy thing. You could take a look at it in the Excel worksheet if you think that's worthwhile to know how to do and or to build. You can see how to build it when we do this problem in Excel. Although, again, there's more Excel formatting that you got to deal with when you look at it there. Then we can look at the amortization schedule, which of course would be the next step. So once we know what the rate is, the amortization schedule will populate on its own. This, if we have it set up properly, this amortization schedule is set up into a table. The table being nice because not only can we see the interest here, we can break out the interest then with the slicer or the filter options so that we could see it basically in a year-by-year breakout. That giving us our year-by-year totals down here, which again, really good, so that we can look at that with regards to what our ending balance will be at the end of any particular year, right there. And we can see what the interest payments will be, which helps us with our projections for taxes and other kind of things of that nature. Now, then the next step, we entered a pivot table. I won't go into a lot of detail on how to enter it because we saw that in a prior presentation, but just realize that I would recommend it's often useful to know how to enter the pivot table and not simply use, the worksheet with a pivot table, because it can get a little bit glitchy. So you kind of want to get good at, if you work with these amortization tables a lot, to be able to construct a table and then add the pivot table, which would be the function of simply inserting a pivot table from here, putting the years on this side, and then the other relevant data, payments, interest, loan, and loan balance down in the values, and then format the values as we saw in a prior presentation. And remember that the loan balance needs to not be a sum value. It needs to be the minimum value so that it picks up the last value in the period in the year. That gives us then this year-by-year breakout, which is quite useful for decision making. Remember that the amortization table up top, really good for us understanding and recording, for example, monthly payments, knowing what the monthly payment is, knowing the breakout between interest and principal, if we are to record that in, say, an accounting system or something like that. But it'd be nice to get kind of on a year-by-year basis, oftentimes, to start making projections in terms of what if I sold it at some future point in the future, what's going to be my tax implications in terms of interest deductions and so on. And then once again, once you have this information set up, you might then pull information from your pivot table to build something like this. This would be something that is outside of the functionality even of a pivot table. It would need like a database program to run these reports automatically, but you can build them fairly quickly with the functionality of a pivot table. So for example, you might say, well, if I keep everything else constant, I had a $400,000 loan, what would be my interest payments per year? And I would like to be able to compare that as if I had a 7%, a 5%, and 2% interest rate. In other words, if I was to change the interest rate from 7%, 5% to 2%, I not only want to know what my different payments will be, which will easily be calculated up top, we also want to know what the differences will be in my interest column on a year-by-year basis, comparing them side by side. So to do that, we can simply refresh our pivot table. We can change the data to be, these per 7%, change the table, and then just copy the interest column and paste the interest column on down below to the relevant interest area. This being 5%. Now we'd have to paste it 1, 2, 3 values only, and this table would not vary as we change the data set up top. That's one of the restrictions we have. But we can put these side-by-side tables together, fairly easily and do more further projections. And we do the same for 7% and 2%. And for example, you might do the same thing with the loan balances. You might say, well, what if I had a 5% versus a 7% versus 5% versus 2%, 400,000 loan holding everything else constant? What then would be my loan balances at the end of each of the 30 years under those? And you simply would copy the final balance over here as you change your pivot table from those different percentages, 7, 5, and 2. And then you could do a side-by-side comparison. And this might help you, for example, to think about, well, what if I sold the home after, say, 10 years? I'd say, well, if I had a 5% rate, I would be at the 3.35 on the loan versus the 2.80. If I had a 2% rate, obviously that would have an impact on possibly the proceeds after paying off the loan at the point of sale at some future point in time. And so this is just some further kind of analysis you can take into consideration depending on your particular circumstances. Again, far and beyond what you can generally do with say, an online calculator that you can't tie into some of this other information. This can give you an amortization schedule, but if you're trying to pull in your data from a 360-point amortization table, 360 row amortization table to figure out, like, what your interest payments will be or what your tax impact will be in the future, and what your, how much, your proceeds might be if you sell the home after the paying off the loan and so on, like 20 years out, and you're trying to hunt down 20 years on the amortization. That could be very tedious. I've done it, very tedious. It'd be nice if you had a better method.